In this video, we are going to give you 3 mistakes that you must avoid when investing in the Kenyan stock market. Unfortunately, these mistakes are very common, yet they have major consequences on the profits that you would have made. The first mistake is overtrading. This means buying and selling your stocks so frequently that the transaction costs begin to significantly impact the profits that you could have made. Let's look at an example of investing in Eveready stocks. At the start of this year, one Eveready stock costs 69 cents. If you bought 10,000 Eveready stocks in January, this would have cost you 6,900 shillings. 6 months later, in June, one Eveready stock cost 1 shilling and 80 cents. Now, your 10,000 stocks would be worth 18,000 shillings. If you chose to sell at this price, you'd have made a profit of 11,100 shillings on this investment. After the minimal 1.63% fee when using the AIB DigiTrader app to invest in stocks, your actual profit would be 10,919 shillings. Now, let's contrast this with an investor who, instead of only making that one trade and making a profit of 11,100 shillings, engaged in up to 100 trades during that 6-month period, aiming to profit on minor price fluctuations in the Eveready stock during this time. Even if this investor ultimately made a profit, the transaction fees incurred would be 100 times those of the first investor. Consequently, this second investor must work significantly harder to ensure that their profits are greater than the cost of these investments. While for the first investor, the cost was a negligible concern. Engaging in numerous small trades is not always negative. However, choosing a more strategic approach with fewer trades might lead to better outcomes. The second mistake, neglecting long-term objectives, where an investor has a long-term objective when investing in a particular stock, but becomes distracted by short-term market developments. For example, an investor who has a positive outlook on a particular stock on the Nairobi Securities Exchange, meaning they anticipate that this stock will perform well over the long term. They decide to invest in this company stock for the next 5 years, expecting the stock price to eventually go up due to the company's ongoing success. However, during the 5-year period, they become preoccupied with monitoring short-term price fluctuations in that stock and lose sight of their long-term strategy. This results in engaging in panic selling when the price drops, or frequently trading the stock, incurring high transaction fees. Eventually, straying from their original long-term objective will decrease their ability to create wealth through this investment. Third and final mistake is chasing the hype. This is one of the most common mistakes, and this occurs when an investor invests in a stock not because of the company's fundamentals or because of any research, but because of the hype around that stock. This especially happens when investors invest in a stock because of the popularity of that stock at that time, rather than a rational evaluation of the company behind the stock, or without advice from a financial professional. Whether making decisions for the short term or the long term, it is crucial to ensure that you have done thorough research or sought guidance from financial professionals. For example, AIB Axis Africa are financial professionals, and we provide stock recommendations to all our clients. Avoiding these 3 mistakes can lead to greater success in your stock investments. To start trading stocks on the Nairobi Securities Exchange, download the AIB DigiTrader app now and begin investing.